Fire sales have begun. The commercial real estate market is crashing, and we just got new news that some properties are selling for a 73% discount. But this couldn't possibly come at a worse time because the banks are taking huge losses on these loans, and the Federal Reserve bailout facility has just hit a new record high. Right when some people have come out from the Federal Reserve, the voting members are saying a pause may not be coming yet. So everyone, please like and subscribe, and let's get into it. Look at this, everyone. San Francisco fire sale. Downtown high-rise is selling for a 73% discount. So it's no longer speculation, everyone. It's no longer fear-mongering doom and gloom clickbait. It is happening. But as I went through this report, I was shocked on how bad it's getting. According to San Francisco Business Times, unnamed sources revealed that 360 California Street high-rise is being purchased by SKS Real Estate Partners at a per square foot price equaling to a value of $60 million to $67.5 million. Again, this figure represents a staggering 73% decrease from the building's valuation in 2020 when it was under the ownership of Union Bank and listed at $250 million. Notably, an investor from South Korea is reported to be involved on the buyer side. The sale of 350 California Street high-rise is generating considerable interest among market participants in San Francisco office market. This transaction could potentially become a new gauge for pricing and have far-reaching implications for future sales and market dynamics. Now, Derek Daniels, the researcher director for San Francisco at Cowan International, shared his insights on this sale. He believes the transaction will serve as crucial data point for the current market conditions, offering valuable insights for potential sales in the area. Daniel also highlighted the positive aspect of an institutional local owner making a substantial investment, despite the buyer needing to inject considerable capital into the property for it to be leased again. The location of the high-rise in North Financial District on California Street adds to its appeal and potential for future success. So it sounds like everything's about to turn around. It's about to get much better, everyone, but unfortunately it isn't. However, it's important to acknowledge the challenges faced by San Francisco office market. The COVID-19 pandemic and the rise of remote work have contributed to persistently high vacancy rates. Daniel expressed optimism for long-term recovery of the market, indicating that layoffs are announced. There may be a shift in management favoring to encourage employees to return to the office. He also highlighted the growth of artificial intelligence sector as a positive driver for future demand. Now, again, that's being very optimistic, but the numbers and the vacancy rates aren't adding up. The sale of this high-rise building comes at a time when San Francisco office market is experiencing unprecedented conditions. Reports suggest a vacancy rate of 29.4% for the first quarter, reflecting the impact of remote work and challenging landscape of work dynamics. So the commercial real estate crash is happening, everybody. These sales are happening now, but we may not get the data until 2 or 3 months. So that's why it's so important for you to go to your local area to see what's really happening on the ground. You can do this by looking at your current area's sales prices on Realtor, or here in Australia we use realestate.com.au. You can go for open inspection to just get out there and speak to real estate agents, even though some of them are a bit untrustworthy. Now again, the markets are all interconnected. So the banks are having huge losses on these commercial mortgage-backed securities, and now the Federal Reserve's bailout facility for these banks is hitting a record high. Listen to this. Fed emergency bank bailout facility hits record high. Money market inflows suggest deposit run is not over yet. So let's unpack the tension that's going on right now in the banking sector between money market inflows and bank deposits fleeing. The report says as regional bank stocks surge higher, creating an illusion of a flawless financial landscape, recent deposit flows paint a different picture. Last week, data revealed a lack of support for the optimistic narrative, and the continued inflows into money market funds suggest that banks are still grappling to retain their deposits. In a remarkable turn of events, money market funds experienced an impressive $13.6 billion of inflows, propelling the aggregate to an all-time high of $5.34 trillion. Yes, that's right, over $520 billion of inflows have flooded into these funds in just the past 3 months. But the situation becomes even more intriguing when we examine the breakdown. Retail funds saw a staggering inflow of over $14 billion, while institutional funds experienced a modest outflow. The surge in money market fund inflows serve as a strong indicator that the upcoming H8 deposit report will likely reveal a continuation of the bank's walk/run phenomenon. But wait, there's much more to this story. Last week witnessed a slight drop in Federal Reserve balance sheet for the first time in 8 weeks. With a decline of $46.3 billion, concurrently the total securities held outright saw a significant drop of $29.8 billion as quantitative tightening has resumed. So this is going to be very interesting to see what consequences this have for the markets, because the markets got very optimistic because the Federal Reserve started printing money again like crazy, issuing another $300 billion on their balance sheet, but now that it's all been undone. Meanwhile, the Federal Reserve backstopping facility remains alarmingly high, sitting at approximately $305 billion. In particular, the Fed's Bank Term Funding Program has reached a new record high of $87 billion, highlighting the ongoing concerns and reliance on central bank support. It's worth noting that the US Central Bank outstanding loans to financial institutions increased to $96 billion, further underscoring the current financial landscape. With the anticipation building of tomorrow's release of the Fed's H8 report on bank deposit flows holds the promise of unveiling more answers. We eagerly await the insights into the impact of seasonal adjustments and whether they hold true or mere illusions in the world of finance. So that's the second piece of the story. Commercial real estate is crashing. Banks are seeing huge outflows of deposits right when we're seeing huge amounts of inflows into money market funds because they can get a much higher interest rate putting their money in a money market fund. For example, the 1 month treasury is paying 5% when you're lucky to get 1 or 2% in a US bank account right now. Now, something the markets were hoping for is the Federal Reserve going to pause their rate hikes, but one of the voting members has come out and said that may be off the table. Listen to this. Dallas Fed President Logan says current data doesn't justify pausing rate hikes yet. So why is that? Let's keep reading. So Dallas Federal Reserve President Lori Logan took the stage with a bold proclamation. The current economic data does not warrant a pause on rate hikes at the upcoming June meeting. Her words reverberated through the financial world, challenging the prevailing expectations. While acknowledging some progress in taming inflation and moderating labor market, Logan emphasized that the Federal Reserve still has a long way to go in achieving its goal of price stability. As a voting member of the Federal Reserve Open Market Committee, her voice carries weight in shaping the nation's monetary policy. So we all need to pay attention to what she says. But will the market align with her stance? Market pricing suggests an anticipation that the Fed will maintain the status quo at the June meeting, halting the rate hiking cycle that began in March 22nd. The CME Group's FedWatch gauge, which monitors prices in the Fed funds futures market, currently assigns a 26% probability of a 0.25 percentage point rate hike at the meeting, though these odds have been steadily rising. Intriguingly, Logan hinted at the possibility that the future data could alter the course, allowing for a meeting to be skipped. However, as of today, she firmly asserts that the time for a pause has not arrived. This is a clash of opinions and uncertainties as fuel to the fire, leaving investors and market participants on the edge. But the drama doesn't stop there, everyone. And to Fed Governor Philip Jefferson, echoing Logan's concerns about elevated inflation. However, he remains cautious, closely monitoring the impact of rate hikes on the broader economy before committing to future moves. Acknowledging the lag inherent in monetary policy, Jefferson reminded us that a year is not enough to gauge the full effect of high interest rates on demand. That's what I've been talking about all along. People have been saying these interest rate hikes haven't really been felt yet because it takes about 6 to 12 months after the rates hit their peak, not from when they start lifting them, before we get the real effects on the economy. Yet Logan's unease persists despite the cumulative 5 percentage points of rate hikes implemented thus far. She sees only modest progress and said there's still a big journey ahead. With an eye on the Fed's longer run goal of 2% inflation, she points to the core personal consumption expenditures price index, which exhibited a worrisome annualized pace of 5.9%, surpassing the 4.4% pace in the previous quarter of 2022. So as tensions build within the Federal Reserve, the ultimate direction of monetary policy remains unclear. Will Logan's conviction hold firm, or will pressure of mounting inflation and economic consideration alter the course? The stage is set, everyone, and the stakes are very, very high. So I know what you're thinking. Well, what does all this finance and economic jargon mean for you in simple terms? Well, what this means is, everyone, the commercial real estate market is crashing, but this is also going to be a big issue for the banks because they're losing huge amounts of deposits. At the same time, these three stories are all interconnected. If the Federal Reserve keeps on lifting interest rates, that's going to keep crashing commercial real estate, and it's going to keep crashing all these assets on these banks' balance sheet, which have already crashed 30 or 40%, and that's the reason why they don't have liquidity for all these deposits, because when someone withdraws their money, they have to sell these assets that they've had huge losses on. So again, everyone, even though a lot of people are saying that the crash is over, we're back in a new bull market, the data does not suggest that at all. And I think this is just a last chance for the global elites to squeeze every last bit of capital out of the retail investor they can before we see the real crash. But everyone, what do you think about all of this? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Again, if you want to sign up to that brand new newsletter, click the link in the description. That way I can stay in touch with you if anything happens on YouTube. And you also get weekly, right now daily, and it's free, in-depth reports on all my research and all the notes I'm doing for these videos. Thanks for watching. I'll see you all in the next video.